Most people believe that high interest rates are bad for everyone. They hear the news reports and feel the direct impact in their own lives. Mortgage payments climb higher, making the dream of home ownership seem more distant than ever before. Car loans become significantly more expensive, adding hundreds or even thousands of dollars to the cost of a necessary vehicle. Credit card balances, which are already a burden for so many, begin to grow at a much faster, more alarming pace. This narrative is simple, it is pervasive, and for the average person, it feels undeniably true. It paints a picture of a struggling economy where everyone is tightening their belts and facing financial headwinds together. This perception is reinforced by almost every conversation we have about the economy. Financial experts on television talk about the cooling effect of high rates, intended to slow down spending and combat inflation. We see headlines about the housing market slowing to a crawl and businesses putting expansion plans on hold. The message is consistent. When the cost of borrowing money goes up, economic activity slows down, and everyone feels the pinch. It's presented as a form of shared sacrifice, a necessary medicine that, while bitter, is required for the long-term health of the economy. We are led to believe we are all in the same boat, weathering the same storm. But this story, the one we are so often told, is incomplete. It focuses entirely on the experience of the borrower, the consumer, and the small business owner. What about the lenders? What about the institutions that are setting these higher rates and collecting these larger payments? While the public narrative centers on shared economic pain, a different reality is quietly unfolding within the fortified walls of the financial industry. A reality where higher rates are not a problem to be endured, but an opportunity to be exploited for immense profit. This common misconception serves a purpose. It creates a sense of inevitability, suggesting that the effects of rising interest rates are a natural and unavoidable force, like the weather. If everyone is struggling, then there is no one to question and no system to scrutinize. It directs our attention away from the fundamental structure of our financial world and toward our own personal budgets. But to truly understand what is happening in 2026, we must be willing to look past this surface-level story. We must begin to question the very premise that high interest rates hurt everyone equally. Because they don't. Not even close. Here is the truth that most people do not realize. While everyday consumers and families are struggling under the weight of increased borrowing costs, the banking sector is quietly entering a golden age of profitability. The very same high interest rates that are causing financial stress for millions are simultaneously fueling record-breaking revenues for the world's largest financial institutions. This is not a coincidence, nor is it a temporary anomaly. It is the predictable outcome of a system that is structured to channel wealth toward those who already control capital. The pain felt by the public is not a side effect of the solution. It is a key component of the profit-making mechanism. In 2026, the era of high interest rates is not an accident. It is the result of deliberate policy decisions made by central banks to manage the economy. However, the consequences of these decisions are not distributed evenly across society. For an individual, a high interest rate is a cost. For an individual, a high interest rate is a liability. For an individual, a high interest rate is a barrier. For a bank, a high interest rate is a product. For a bank, a high interest rate is a price tag. For a bank, a high interest rate is a source of revenue. The system is designed to reward institutions that possess three critical advantages: vast amounts of capital, easy access to liquidity, the power to set the prices. At the same time, it systematically penalizes those who lack these advantages, namely, the average citizen. This dynamic has created a stark divergence in fortunes. As the cost of living rises and wages struggle to keep pace, many households are forced to take on more debt just to maintain their standard of living. They turn to credit cards, they turn to personal loans, they turn to lines of credit, all of which now come with much higher interest rates. For the banks, this increased demand for credit, coupled with the higher price of that credit, creates a perfect storm for profitability. They are lending more money at higher margins than they have in decades. It is a business model that thrives on the financial pressures faced by the general population. The silence around this phenomenon is deafening. The financial news may report on a bank's quarterly earnings, but it rarely connects those soaring profits directly to the hardships faced by consumers due to high rates. The two stories are told as if they are unrelated events occurring in parallel universes. But they're not. They're two sides of the same coin. The wealth being accumulated by the banking sector is a direct transfer from the pockets of borrowers. Understanding this hidden truth is the first step towards seeing the modern financial system for what it truly is: not what we are told it is. It is crucial to understand this outcome is not a conspiracy or a secret plot in a boardroom. It is straightforward and more troubling. The system is working as designed. Modern finance rests on a fundamental asymmetry. Banks don't mainly lend their own money. They lend depositors money and funds borrowed cheaply from central banks and other institutions. They are intermediaries between cheap capital and expensive credit. Their business is managing the gap between what they pay for money and what they charge for it. High interest rates supercharge that model. Imagine a bank as a merchant buying wholesale, selling retail. Interest rates are the price tag. When the central bank raises its key rate, wholesale costs rise. Banks can raise retail rates, the rates on mortgages, car loans, credit cards, almost instantly. They raise what they pay for inventory. Savings rates, much more slowly and usually by less. That gap, the net interest margin, widens as rates rise. In this analysis, we are going to move beyond the headlines and break down exactly how this transfer of wealth occurs. We will explore the specific mechanisms that allow banks to thrive in a high interest rate environment while so many others struggle. This is not about assigning blame or promoting a particular ideology. It's about providing financial clarity and pulling back the curtain on the machinery of the modern economy. By the end, you will have a clear and comprehensive understanding of why 2026 is proving to be such a profitable year for the banking industry. We will examine several key areas in detail. First, we will dissect the core profit engine of any bank, the interest rate spread. We will look at how banks source their funds and how they price their loans. We will explain why borrower rates rise much more quickly than the rates paid to savers. Next, don't higher savings rates balance things out. We'll show why, after accounting for inflation, taxes, and the slow pace of rate increases, most savers still see the real value of their money decline. Why a 4% savings rate is not the windfall it seems. Next, debt, the most profitable product in a high-rate world. Credit cards, variable rate loans. The structure of minimum payments and compounding interest creates a hard-to-escape cycle of debt and steady revenue for lenders. Then, the relationship between inflation and bank profitability, rising prices, high interest rates. Together they give institutions with pricing power a major advantage. Finally, what this means for you. We won't give financial advice, we'll give financial awareness. Strategies smart individuals can use to protect themselves and navigate this landscape. This isn't about fighting the system. So you can make more informed decisions. What we are about to discuss is not speculation, not theory, or a forecast of what might happen. It is a straightforward explanation of how the modern financial system actually works today in 2026. The principles that govern bank profitability are not secret or mysterious. They are well documented and are the basis of the entire industry. They can be found in the annual reports of every major bank in the textbooks used to train financial analysts and in the policy documents of central banks around the world. The only thing unusual is having them all laid out in plain, accessible language. Our goal is to demystify the language of finance and translate complex economic concepts into clear, tangible ideas. Net interest margin, asset liability management, liquidity provision. These terms can seem intimidating, but they describe simple business practices that affect your financial life. We will break down these concepts with relatable examples and show you the math behind the curtain. A seemingly small difference of a few percentage points when multiplied across trillions of dollars in assets becomes billions in profits. This is about scale, leverage, and incremental gains. This is not a story of good versus evil. Banks are not acting maliciously. They are acting rationally within existing incentives. They are for-profit corporations with a fiduciary duty to shareholders to maximize returns. The system is structured to let them do this most effectively during high, volatile interest rate periods. The issue is the emergent properties of the system, not one institution's motive. Understanding this moves us past outrage toward a sober assessment of our economic reality. So, let's begin. Forget what you think you know about interest rates from common wisdom and media soundbites. Prepare to look at the financial system from a different perspective, as a consumer, as a borrower, as an analyst observing a machine designed for a specific purpose. By understanding its mechanics, you gain a powerful advantage. You are no longer just a passive participant, but an informed observer who understands the rules of the game. Let us start with the absolute foundation, what high interest rates truly mean for the economy, and, more importantly, for the banks that operate within it. Interest rates are the central nervous system of the modern economy. They function like a global thermostat, set by central banks to cool or heat economic activity. When the economy is running too hot, leading to high inflation or potential asset bubbles, central banks raise interest rates. This makes borrowing more expensive, which is intended to slow down spending, investment, and hiring. Conversely, when the economy is sluggish, they lower rates to make borrowing cheaper, encouraging businesses to expand and consumers to spend. This mechanism influences the flow of every dollar, from a nation's sovereign debt to the balance on your personal credit card. On the surface, this seems logical and balanced. It's presented as a sophisticated tool for macroeconomic management, a way to steer the economy away from recession or runaway inflation. Decisions by a handful of policymakers at institutions like the Federal Reserve or the European Central Bank ripple outward, touching households and businesses. A quarter-point increase in the federal funds rate might seem abstract, but it quickly translates into concrete changes. The cost of a new mortgage, the monthly payment on a car, and interest accruing on student loans are all tied to the central rate. However, seeing rates as a neutral tool is incomplete. The temperature is not felt uniformly by everyone. For most people and small businesses, a rise in rates feels like turning down the heat in winter. It gets colder, harder, and more costly to stay comfortable. The flow of credit, the lifeblood of a consumer economy, becomes constricted and more expensive. But for banks at the center of the system, the thermostat works differently. For them, rates are not just a cost to endure, they are a core part of product pricing. A change in the central bank's rate is a business opportunity. It's the signal to adjust prices of their own goods, loans, and credit to their advantage. When the economic thermostat is turned up, inside the bank's headquarters, it does not get colder. Instead, it becomes the perfect climate for cultivating unprecedented profits. When interest rates rise, their effects can be understood through 4 primary channels, each impacting a different aspect of our financial lives. These 4 pillars are loans, savings, borrowing behavior, and the existing weight of debt. For the average person, the changes in these 4 areas are almost universally negative, or at best, a mixed bag with significant downsides. They represent the primary ways in which the central bank's policy of economic cooling is transmitted directly to the household level. Understanding how each of these pillars is affected is crucial to seeing the full picture of what high rates truly mean for the majority of the population. The first pillar is loans. This is the most direct and obvious impact. Any new borrowing, whether it is for a home, a car, an education, or a business, becomes more expensive. The monthly payments are higher, and the total amount of interest paid over the life of the loan increases dramatically. The second pillar is savings. In theory, higher rates should make saving more attractive, as banks offer a better return on deposits. This is often presented as the silver lining for consumers in a high-rate environment. However, as we will explore, the reality is far more complex and often less rewarding than it appears on the surface. The third pillar is the overall level of borrowing in the economy. As loans become more expensive, the natural consequence is that borrowing slows down. This is the intended effect of the policy, to curb demand. Businesses postpone investments, potential homebuyers are priced out of the market, and consumers think twice before making large purchases on credit. The engine of economic expansion begins to sputter as its fuel, cheap credit, becomes scarce. Finally, the fourth and perhaps most burdensome pillar is the impact on existing debt. For the millions of individuals and businesses with variable rate loans, such as credit cards, home equity lines of credit, or certain business loans, a rate hike is not a future problem, but an immediate one. Their interest costs rise automatically, increasing their monthly financial obligations without them taking on any new debt. This makes existing debt heavier and more difficult to manage, trapping many in a cycle of payments where the principal balance barely decreases. These four pillars form the foundation of the high-rate experience for the public, an experience defined by higher costs and increased financial pressure. Section 3. Loans, the price of ambition. When interest rates go up, the cost of ambition rises with them. Buying a first home, purchasing a reliable car to get to work, starting a small business, funding a child's education. The price of the loan, the interest you pay, is a direct tax on aspiration. A mortgage is the most prominent example. A seemingly small increase from 4% to 7% does not just slightly increase the monthly payment, it can add hundreds of thousands of dollars over 30 years. This increase acts as a powerful brake on economic mobility. It disproportionately affects younger generations and first-time buyers who haven't built equity or savings. They find themselves priced out of the housing market, forced to continue renting while home values may still be rising. This is not just a personal disappointment, it has broader economic consequences. The housing market supports industries like construction and furniture manufacturing. When the housing market cools, the entire economy feels the chill. The same dynamic plays out for small businesses. An entrepreneur seeking a loan to buy new equipment, to expand to a second location, or simply to manage cash flow. This can be the deciding factor between expansion and stagnation, between hiring new employees and laying off existing ones. Unlike large corporations that can issue bonds, small businesses are heavily reliant on traditional bank loans. When the price of those loans goes up, their ability to compete and grow is curtailed. For banks, however, this situation is entirely different. The higher price of loans is not a barrier, it's their primary source of increased revenue. They are the sellers in a market where the price of their main product has gone up. Every new mortgage, every new car loan, every new business loan is now more profitable than before. While the borrower sees a heavier burden and a constrained future, the lender sees an improved margin and a stronger income statement. The very same rate hike that closes a door for a family, or for a small business, opens a window of opportunity for the bank that holds the key. Section 4. Savings, the illusion of reward. On the surface, high interest rates seem to offer a rare benefit to the average person, a better return on savings. After years of earning next to nothing on the money kept in a savings account, the prospect of earning 4% or even 5% can feel like a significant victory. Financial institutions heavily market these higher rates, encouraging customers to deposit more money to take advantage of the attractive yields. This narrative suggests a rebalancing of the scales, where prudent savers are finally being rewarded for their discipline. It creates the impression that while borrowers are paying more, savers are earning more, and it all evens out. This perception, however, is a carefully constructed illusion. The first and most significant factor that shatters this illusion is inflation. If a savings account is paying 4.5% interest, but the rate of inflation is 3.5%, the real return, the actual increase in your purchasing power, is only 1%. In many cases, especially in the early stages of a rate hiking cycle, the interest rate offered on savings accounts remains below the rate of inflation, meaning savers are still losing purchasing power, just at a slightly slower pace. The second factor is taxes. The interest earned on a standard savings account is considered taxable income. So, if you earn $450 in interest on $10,000 of savings, you must pay income tax on that $450. Depending on your tax bracket, this could reduce your effective return by 20% to 30% or more. When you combine the effects of inflation and taxes, that appealing 4.5% nominal return can quickly become a negative real return. For example, with 3.5% inflation and a 25% tax rate, your after-tax real return is actually negative. You have more dollars, but those dollars can buy less than they could a year ago. Most importantly, the relationship is asymmetrical. Banks raise the rates on loans immediately and by a large margin, but they inch up the rates on savings accounts slowly and reluctantly. They have no incentive to do otherwise. Every basis point they pay out to savers is a direct reduction in their net interest margin. They will only raise deposit rates as much as they absolutely have to in order to attract and retain the deposits they need to fund their more profitable lending activities. So, while the cost of borrowing skyrockets overnight, the reward for saving trickles in over months, and it is quickly eroded by inflation and taxes, leaving the saver with little more than an illusion of progress. Section 5. Borrowing, the engine slows down. The primary, intended consequence of raising interest rates is to slow down the pace of borrowing across the entire economy. It is a deliberate act of applying friction to the gears of commerce. When the cost of credit increases, the demand for it naturally decreases. This slowdown is not an unfortunate side effect. It is the central objective of the policy. The goal is to cool demand to a level more in line with the economy's ability to supply goods and services, easing inflation. This slowdown manifests in visible ways, from the housing market to corporate balance sheets. For consumers, the decision-making process for large purchases changes dramatically. A family planning to buy a new car sees new, higher monthly payments and chooses to repair their old car instead. A couple with a saved down payment finds the monthly mortgage now beyond their budget and puts their plans on hold. This pullback in consumer spending on big-ticket financed items has a cascading effect. Car dealerships see less foot traffic. Real estate agents close fewer deals. Retailers of furniture and appliances see sales decline. For businesses, the calculation is similar but with higher stakes. A company's decision to invest in a new factory, upgrade its technology, or expand its workforce depends on return versus the cost of capital. When interest rates rise, the cost of capital goes up and fewer projects are viable. Profits that worked at 5% loans can fail at 8%. Businesses become more cautious. They scale back investment plans. They freeze hiring. They focus on cost-cutting over growth. For banks, though, it's a change they're prepared for. New loan volume may decrease, but profitability per loan increases. Banks trade quantity for margin. Demand rises for other credit, working capital loans, and consumer credit card usage. The engine of the broad economy slows, but the profit engine inside banks is tuned for efficiency. While high interest rates make new borrowing more expensive, their most insidious effect is on the debt that people already hold. Not all debt is created equal. Fixed-rate loans, like most standard mortgages, are protected. The interest rate is locked in for the term of the loan, so a rise in market rates does not change the monthly payment. But a huge and growing portion of debt is not fixed. Consumer debt, business debt. It is variable. The rate is contractually tied to a benchmark. That benchmark moves up and down with the market. When the central bank raises rates, servicing costs increase automatically and immediately. Credit cards are the most common and punishing example. Nearly every card has a variable APR. When the federal funds rate rises by 0.5%, the APR on your balance typically rises by the same amount within 1 or 2 billing cycles. For tens of millions of households carrying balances month to month, their debt burden grows heavier without extra spending. Interest charges increase, making it harder to pay down principal. This creates a vicious cycle. As the interest portion of the minimum payment increases, even less of the payment reduces the balance. The debt becomes stickier, lingering and accumulating more interest. A balance that might take 5 years to clear might now take 7 or 8 years, with those extra years almost entirely interest paid to the bank. Revolving credit becomes a long-term revenue stream for banks. The bank doesn't need you to default. It simply needs you to carry the balance. Same principle for other variable rate debt. Home equity lines of credit. HEOAEC. Small business lines of credit and loans. Homeowners who tapped equity at low rates see monthly payments escalate. Small businesses relying on credit lines see interest costs rise and margins squeezed. For those affected, high rates are not abstract. They are a tangible monthly weight that grows heavier, making past financial decisions a heavy burden on the present. For the average person, an interest rate is a cost. It is the price you pay to borrow money. For a bank, an interest rate is something entirely different. It is a pricing tool. This distinction is the single most important concept to grasp when trying to understand why high-rate environments are so profitable for banks. A bank is, at its core, a business that sells a product. That product is money, or more accurately, credit. The interest rate is the price tag they put on that product. Just like a clothing retailer adjusts the price of a sweater based on demand and wholesale cost, a bank adjusts the price of a loan based on market conditions. When the central bank raises its key policy rate, it is effectively increasing the wholesale cost of money for the entire system. But banks are not passive takers of this price. They are active price setters. They have the power to decide how much to mark up their product. A grocery store might buy a can of soup for $1 and sell it for $2. A bank effectively buys money through deposits and borrowing from the central bank at one rate and sells it through loans at a much higher rate. The central bank's actions give them the perfect justification to increase their retail prices across the board. This perspective transforms the entire dynamic. A high interest rate is not a problem for the bank to solve. It is a feature of the market that they can leverage. They do not suffer from high rates, they monetize them. Their teams of analysts and strategists, known as asset liability managers, spend their days modeling how to price their vast portfolio of loans and securities to maximize profit in any given rate environment. When rates are rising, their models tell them to increase the price of mortgages, car loans, and business loans as quickly as possible to capture the higher margin. This ability to actively manage their pricing is a power that no individual consumer or small business possesses. You cannot negotiate the interest rate on your credit card. A small business owner has very little leverage to bargain for a better rate on a loan when all banks are raising their prices in unison. Banks operate from a position of immense pricing power, a power that is only enhanced during periods of monetary tightening. They are not simply reacting to the market, they are shaping the market's impact on their customers to their own benefit. The interest rate is their tool, and they are masters at using it. At the heart of a bank's profitability lies a simple concept: the spread. The interest rate spread, or net interest margin, is a single metric. It's the difference between interest income earned and interest paid out. It is the fundamental business model of banking. Banks are intermediaries. They borrow cheap and lend expensive. The wider the spread, the more profitable the bank. High interest rate environments let that spread widen. Think of a bank's balance sheet: assets, loans to customers, mortgages, car loans, credit cards, securities the bank holds. These assets generate interest income. Liabilities, customer deposits. Deposits are money the bank owes and pays interest on. The bank manages rates earned on assets versus rates paid on liabilities. When the central bank raises its benchmark rate, banks can raise asset rates fast. New mortgages are issued at higher market rates. Variable rate credit cards adjust up. Business lines of credit adjust up. The income from the asset portfolio climbs quickly, but the bank controls how fast it raises deposit rates. It doesn't have to raise savings accounts rates. It doesn't have to raise checking accounts rates. This creates a profitable lag. Loan interest revenue rises fast. Deposit funding costs rise slow. The spread between them widens. A 0.5% increase in NIM can mean billions of extra profit on a multi-trillion balance sheet. This is intentional, strategic decisions to maximize profit. The art of banking is managing and expanding this spread. The key to understanding how banks profit from rising rates lies in one word: timing. Banks have a structural advantage that allows them to reprice their assets and liabilities at different speeds. It is a race between how quickly they can charge you more and how slowly they can pay you more. It is a race that, by the very design of the system, they are guaranteed to win. This timing mismatch is not a minor detail, it is the core mechanism through which wealth is transferred from consumers to financial institutions during a monetary tightening cycle. When the central bank announces a rate hike, the effect on a bank's lending rates is almost instantaneous. Within hours, the advertised rates for new mortgages and personal loans are adjusted upwards. For existing variable rate products like credit cards, the change is often programmed to take effect in the next statement cycle. This rapid repricing of assets ensures that the bank's revenue stream immediately reflects the new, higher rate reality. Their income begins to accelerate from the very moment the policy change is announced, capturing the full benefit of the higher price of credit. In stark contrast, the rates paid on savings accounts and other deposits move at a glacial pace. Banks are under no obligation to pass on the full rate hike to their depositors, nor are they required to do so quickly. They will typically wait, watch what their competitors are doing, and raise their deposit rates incrementally over many weeks or months. They might raise a 5% savings rate by only a quarter of a point when the central bank has raised its rate by half a point. They do this because every dollar they do not pay out in deposit interest is a dollar that drops directly to their bottom line. This creates a highly profitable window of time, which can last for months, or even years, where the bank's lending rates are high, but its funding costs remain relatively low. The gap or spread between what they earn and what they pay widens considerably during this period. The bank is essentially running a race against itself, and it has complete control over the speed of both runners. It lets the revenue runner sprint ahead while holding the expense runner back at the starting line. This timing advantage is a built-in feature of the banking system, and it is never more powerful than in a period of rapidly rising interest rates. If debt is the bank's profit center, credit card lending is the crown jewel within that center. No other lending product combines high interest rates, variable rate structures, and consumer behavioral patterns to create a consistent and extraordinarily profitable line of business. But for the major banks that dominate the credit card industry, this single product category can account for a disproportionately large share of their overall profitability. The high-rate environment of 2026 has transformed this business into a money-printing machine of unprecedented scale and efficiency. The interest rates on credit cards, known as the APR, are in a league of their own. Mortgage rates might be at 8%, car loan rates at 10%, but standard credit card APRs often start at 20% and can easily exceed 30% for consumers with less than perfect credit. This enormous spread above the bank's cost of funds makes every dollar of credit card debt carried by a consumer immensely profitable. The risk of default is higher than with a mortgage, but this risk is more than compensated for by the extraordinarily high rates charged to the entire pool of borrowers. What makes credit cards so powerful for banks is their revolving nature. Unlike an installment loan with a fixed end date, a credit card allows a consumer to borrow, repay, and borrow again, creating a potentially perpetual debt relationship. The bank does not want you to pay off your balance in full each month. That makes you a transactor and generates very little revenue for them. Their ideal customer is a revolver, someone who carries a balance from month to month, consistently paying the high interest charges. The entire industry is built around encouraging and sustaining this revolving behavior. In 2026, as inflation puts pressure on household budgets, more and more people are turning to credit cards to bridge the gap between their income and expenses. They use plastic to pay for groceries, gas, and utilities. This increases the total outstanding credit card debt in the system. At the same time, the high interest rates mean that this larger pool of debt is now generating revenue for the banks at a much higher margin. It is a perfect storm for profitability. More customers are borrowing more money at a higher price than ever before. The single most powerful feature of the credit card as a profit-generating tool is its variable annual percentage rate, the APR. As we touched on earlier, this mechanism contractually links the interest rate on your card to an external benchmark, almost always the prime rate. This means that when the central bank raises its policy rate, your credit card APR automatically increases by the exact same amount, usually within 1 or 2 billing cycles. This feature allows the bank to instantly pass on the effects of monetary policy to its borrowers, protecting and enhancing its profit margin in real time. This repricing mechanism functions like a one-way street that always slopes in the bank's favor. When the central bank is raising rates to fight inflation, as it has been leading into 2026, the variable APR structure ensures that the bank's revenue from its entire portfolio of credit card debt rises in lockstep. A series of 8 quarter-point rate hikes over 18 months translates directly into a 2% increase in the APR for every single customer carrying a balance. This is an automated, system-wide revenue enhancement that requires no action or negotiation from the bank. The reverse, however, is not always true. While credit card agreements legally bind the rate to go up with the benchmark, they often give the bank discretion in other areas. For example, a bank can raise a customer's rate for reasons unrelated to the prime rate, such as a late payment or a change in their credit score. Furthermore, when central banks eventually begin to lower rates, there is no guarantee that banks will reduce the spread or margin component of the APR. The benchmark rate may fall, but the bank might keep its markup high, capturing an even wider spread in a falling rate environment. Section 11. The minimum payment trap. The structure of the minimum monthly payment is clever financial engineering built to maximize bank profits. To the uninformed consumer, it looks helpful, a low manageable amount when money's tight. But its true function is to keep borrowers in debt, maximizing the total interest they will pay. It's a calculated trap encouraging long-term, high-cost revolving debt. Most minimum payment formulas combine a small percentage of the balance, typically 1 to 2%, plus interest, plus fees. When interest rates are low, more of the minimum payment can go to principal. When rates are high, the interest portion swells. More of the minimum is eaten by interest, leaving only a tiny amount, sometimes a few dollars, for principal. It becomes almost interest only. A borrower can pay the minimum every month for years and see the balance barely move. For example, $5,000 at 24% APR means about $100 in monthly interest. If the minimum is only $120, only $20 actually reduces the balance that month. The minimum payment isn't a lifeline, it's the bait in a profitable trap. Section 12. The power of negative amortization. Dangerous phenomenon. Negative amortization. Minimum payment less than monthly interest. Unpaid interest is added to principal. Borrower makes payments. Debt still grows each month. They think they're doing the right thing while digging a deeper financial hole. Most common with credit cards, when a low fixed minimum payment is in place, and when interest rates rise significantly. Example, $25 minimum payment, or 2% of the balance. Balance, $1,500. APR, 28%. Monthly interest, $35. Pays $25 minimum. Balance increases by $10. New balance, $1,510. Negative amortization. Shock, the ultimate debt trap. For banks, it's grimly profitable. Loan asset grows, interest income rises monthly. This shows how high interest mechanics favor lenders. The system punishes those who can only pay the minimum. Temporary struggle becomes long-term, inescapable debt. Section 13. Compounding interest, the bank's eighth wonder. Albert Einstein is often apocryphally quoted as having said that compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. While the quote's origin is uncertain, its wisdom is undeniable. For savers, the power of compounding is severely muted by inflation and taxes. But for banks on the lending side, compounding interest is a silent, relentless engine that drives their profitability ever upward. Compounding works by charging interest not only on the original principal amount, but also on the accumulated interest from previous periods. With credit cards, this happens daily or monthly. It's a snowball effect. The longer a balance is carried, the faster it grows, as you are paying interest on top of interest. In a high-rate environment, this compounding effect becomes exponentially more powerful. The difference between a 15% APR and a 25% APR is not just the 10-point gap, it's the dramatically accelerated rate at which the balance will compound over time. The bank understands this principle intimately. Its entire business model for revolving credit is built around maximizing the revenue from compounding. They know that a certain percentage of their customers will become trapped in a compounding debt cycle. While the consumer experiences compounding as a stressful and ever-increasing burden, the bank sees it as a predictable and highly lucrative feature of its most profitable product line. They are the ones who understand it, and therefore, they are the ones who earn it. The combined effect of high variable APRs, minimum payment structures, and the power of compounding is the creation of perpetual revenue streams for banks. For many customers, revolving debt stops being short-term and becomes a long-term, annuity-like income source. The bank becomes more than a lender, a de facto partner in someone's financial life, siphoning a percentage of income monthly as high-margin interest. Consider a typical credit card revolver's life cycle. They may start with a small balance, then face life events, emergencies, or simple overspending, and the balance grows. Years pass, original purchases are forgotten, but the debt stays, a constant obligation. For the bank, this is a perfect asset, not in default, paying and in good standing yet not reducing principal meaningfully. It's like paying a subscription fee for having been in debt. This revenue is stable and predictable. Banks can forecast income from millions of revolving accounts. It's more reliable than many other revenue sources. The consumer debt machine's goal: convert a one-time purchase into a long-term high-margin relationship. Banks don't want you to pay off debt quickly. They also don't want you to default. The sweet spot is shown as a customer trapped in a circular payment loop. In the high-rate environment of 2026, conditions are ideal to create and sustain millions of these perpetual revenue streams. Section 4. The business of bad debt, selling off non-performing loans. Even after a loan has defaulted and been written off against provisions, the story does not end there for the bank. A defaulted loan is not a worthless asset, it is simply a non-performing one. The legal claim on the borrower still exists, and there is still a chance of recovering some of the money. The business of collecting on defaulted debt is a difficult, specialized, and often unsavory process. Rather than engage in this directly, banks have another powerful tool at their disposal. They can sell their bad debt to a thriving secondary market of specialized debt collection agencies. A bank might sell a portfolio of defaulted credit card accounts with a face value of $100 million to a debt buyer for just $3 million or 3 cents on the dollar. From the bank's perspective, this is a great deal. They receive an immediate cash payment for an asset they had already written off as a near total loss. This cash recovery is pure upside that flows directly back to their bottom line. For the debt buyer, the business model is to then try to collect as much as they can from the individuals in the purchased portfolio. Because they bought the debt so cheaply, they only need to recover a small fraction of the original balances to turn a handsome profit. They use aggressive and persistent collection tactics, constant phone calls, letters and legal action to pursue the debt which they now legally own. The original bank is completely removed from this process, its hands clean, having already booked its recovery and moved on. This ability to sell off bad debt is a crucial part of the risk management system. It allows the bank to efficiently dispose of its non-performing assets, clean up its balance sheet, and convert a potential zero into a small but certain cash gain. It outsources the most difficult and reputationally risky part of the lending cycle to a third party. This ensures that the bank's own operations can remain focused on its profitable core business of originating new loans. Section 7. The Great Divide: Large Corporations versus Small Businesses. It is a critical mistake to think of business lending as a single monolithic category. In the high-rate environment of 2026, a great divide has emerged, separating the borrowing experience of large, publicly traded corporations and small and medium-sized enterprises. Main Street businesses both need capital, but their ability to access it, the terms they receive, and their power to negotiate are worlds apart. Two parallel realities form. Large corporations strategically manage expensive debt, while small businesses struggle under its weight. Large corporations have powerful financial tools and advantages. Sophisticated treasury departments staffed with financial experts. They can access multiple funding sources: traditional bank loans, public bond markets, commercial paper. Their massive scale and long track record create bargaining power with lenders. They can pit banks against each other to win better terms. Small businesses, by contrast, operate at a profound disadvantage, often reliant on a single funding source, a local or regional bank. They lack scale and sophistication to reach public debt markets. Their negotiating power is minimal, price takers, not setters. So when banks tighten standards and raise prices in a high-rate environment, small businesses bear the brunt. This divide is a defining feature of the economic landscape. Headlines may scream, credit crunch, but the truth is more nuanced. For the largest, credit is not scarce, just more expensive. For small businesses, credit can be prohibitively expensive and genuinely scarce. This flight to quality widens the gap between the financial haves and have-nots, hurting dynamism and competition. If the banks are so well protected and are, in fact, profiting handsomely from the high-rate environment, it begs the question, who is on the other side of this transaction? A system that creates such clear winners must, by definition, also create losers. The wealth and security being accumulated by the financial sector are not being created out of thin air. They are the result of a massive transfer of resources and a reallocation of risk. The losers in this scenario are not a single, monolithic group, but a broad cross-section of society, each affected in a different but equally damaging way. The casualties of the high-rate environment of 2026 are the individuals and households who lack the scale, sophistication, and structural protections that the banks enjoy. They are the price takers in a market where the banks are the price setters. We can identify several key groups who are disproportionately harmed by this system. The fixed income household, the credit-dependent consumer, the small saver, the variable rate borrower. By understanding their specific predicaments, we can see the full, human cost of the system that is making banks richer than ever. These are not just economic categories, they are millions of people whose lives are being made more difficult by the same policies, creating a golden age for lenders. The first and perhaps most vulnerable group of losers are those living on a fixed income. Retirees who rely on pensions, annuities, or the interest from their past savings. They are caught in a vice between a fixed stream of dollars coming in and a rapidly rising cost for everything going out. The cost of their groceries, prescription drugs, and utilities is going up. But their income is not. This forces them to make painful choices, cutting back on essentials, dipping into their principal savings faster than planned, or forgoing activities that bring them joy and social connection. The small gain on their savings is nowhere near enough to offset the dramatic increase in their cost of living. They are fighting a losing battle, their life savings acting as a melting iceberg in a warming sea. This group represents the quietest and often most overlooked casualty of the system. Their financial struggle does not always show up in unemployment statistics or default rates. It is a slow, grinding decline in their quality of life. The overwhelming conclusion from this deep analysis can be a feeling of powerlessness. When faced with a system so vast, so complex, and so structurally tilted in favor of powerful institutions, it's natural to feel like a tiny, insignificant cog in a massive, indifferent machine. The narrative of inevitable bank profitability can lead to resignation, a belief there's nothing to be done but to accept being a price taker, a risk bearer, and a source of profit for the financial sector. This feeling, while understandable, is ultimately an illusion. No single person can change the global financial structure, but you are not powerless within it. The system depends on your participation, and on your predictable, often uninformed behavior. Banks' profit model is built on consumer inertia, information asymmetry, and common psychological biases. Refuse to be inert, uninformed, and predictable, and you can reclaim personal power and financial agency, even inside this imbalanced system. Power doesn't mean overthrowing the system. It means understanding it so well you can navigate it to your own advantage, or at least to your minimal disadvantage. The first and most important principle is to relentlessly minimize and eliminate high-interest variable rate debt. The second principle is to develop a deep and practical understanding of the difference between fixed and variable rates for every financial product you use. The third principle is to obsess over your cash flow efficiency. Do not let inertia keep your emergency fund in a checking account earning 0%. In a high-rate environment, the difference between a standard savings account and a top-tier high-yield account can be thousands of dollars a year. Fight against the stickiness that banks rely on for their cheap funding. Make them pay for your capital. If there is a single, overarching message to take away from this entire discussion, it is this. In the world of finance, information is leverage. The structural advantages enjoyed by the banking sector are built upon a mountain of expertise, data, and a deep understanding of the rules of the game. Their power is derived not just from their money, but from their knowledge. By arming yourself with a clear and unsentimental understanding of how this system truly operates, you gain the only form of leverage that is available to an individual. You can begin to make informed decisions rather than emotional or passive ones. Understanding the mechanics of the interest rate spread should motivate you to fight for every last basis point on your savings and to scrutinize every basis point on your loans. Understanding the illusion of the saver's silver lining should cure you of the belief that a 5% savings rate is making you rich, and instead focus you on your real, after-tax return and your after-inflation return. Understanding the profitability of the debt machine should instill in you a healthy fear of revolving credit and a fierce determination to avoid its traps. Knowledge transforms you from a passive subject into an active agent. It allows you to protect your own family's finances, to educate others in your community, and to participate in the broader societal conversation about our financial system from a position of strength and clarity. High interest rates, like all economic conditions, will not last forever. The cycle will turn again, but the fundamental structure of the system and the advantages it confers upon those at its center will remain. The knowledge you have gained, however, is permanent. It is the one asset that cannot be devalued by inflation or diminished by taxes. It is the ultimate tool for building a more secure and resilient financial life, not just for 2026, but for all the years and all the economic cycles to come. In finance, as in life, the most valuable investment you can ever make is in your own understanding.